This is Jessica Dunn, and we're going to continue our discussion of cost of capital and discuss the weights that we use in the weighted average cost of capital calculations. The weights are the percentages of the firm that will be financed by each component. If possible, we always use target weights for the percentages rather than the existing. A value maximizing firm will find its target capital structure and then raise new capital in a manner that keeps the capital structure on target over time. So if you don't necessarily know what the target capital structure is, you could use the existing capital structure and assume that they're on track to meet their target capital structure. So if you don't know the targets, it's better to estimate the weights using current market values rather than book values. If you don't know the market value of debt, then you could use the book value of debt, especially if the debt is short term. So let's look at estimating the weights. Let's suppose that the stock price is $50. There are 3 million shares of stock, and the firm has 25 million in preferred stock and 75 million in debt. So to calculate that, let's first look at the value of the common stock. It's $50 per share, and there are 3 million shares outstanding. That means that the market value of common stock is 150 million. The value of preferred stock, 25 million, and the value of debt is 75 million. So the value of the whole company, the value of the company is going to be equal to the value of the common stock plus the value of the preferred stock plus the value of debt. And so that tells us that the value of the company is $250 million. So we need to calculate the weight of each of these. So if we know that the value of common stock is 150 million, and we know that the value of the whole company is 250 million, then that means that the value of the common stock, or the weight of the common stock is 60%. The weight in the debt would be the 75 million divided by the 250 million dollar value of the company, and that gives us 30%. The weight in preferred stock is the 25 million divided by the 250 million cumulative value, and that gives us 10%. Now, one thing to note is that these do have to sum to 100. 60 plus 30 plus 10 is 100%. So let's assume that the target weights for this company are the same as their current market weights. Market weights do sometimes deviate from targets because stock prices do fluctuate, but the company should consistently strive to meet those target weights. So let's remember that the cost of debt was 6%, the cost of preferred stock was 9%, and the cost of common stock was 12.8%. Now remember, this was the after-tax cost of debt. The before-tax cost of debt was 10%, and we had a tax rate of 40%. So using the weighted average cost of capital, that says that the cost of debt times the weight in debt times 1 minus the tax rate plus the weight in preferred stock times the cost of preferred stock plus the weight in common stock times the cost of common stock equity is the overall weighted average cost of capital. So if instead you had chose to use the after-tax cost of debt, you just would eliminate this 1 minus the tax rate. So let's plug in what we know. We know that we have a cost of debt of 10%, pre-tax cost of debt. Multiply that by the weight in debt, which was 30%, times 1 minus the 40% tax rate, plus the weight in preferred stock. Our weight in preferred stock was 10%, multiplied by the cost of preferred stock, which was 9%. Add to that the weight in common stock, 60, plus the cost of common stock, 12.8%. And so that gives us a weighted average cost of capital of 10.38%, which we can round to 10.4. Remember that the weighted average cost of capital is the cost the company would incur to raise each new marginal dollar of capital. It's not the average cost of dollars raised in the past, because we're looking at the future. What is it going to cost us to begin a new project? How are we going to finance that? How is it going to, what rate of return do we have to earn to compensate us for the cost of beginning a new project? So there are different factors that influence a company's weighted average cost of capital. Some of those are controllable and some aren't. So the uncontrollable factors include market conditions, especially interest rates, the market risk premium and taxes. Controllable factors, capital structure decisions, how much of your company is going to be financed by debt, equity. What dividend policy do you have? Are you reinvesting those earnings or are you distributing them? And what is your investment policy? Are you investing in risky projects with a high cost of equity, or are you taking a more moderate approach? The weighted average cost of capital is not correct for each of the company's divisions. The composite weighted average cost of capital reflects the risk of an average project undertaken by the firm. Different divisions may have different risks, so you can use divisional weighted average cost of capital to reflect the risk associated with that particular division. So the risk-adjusted divisional cost of capital, first you estimate the cost of capital the division would have if it were a standalone firm. So this would require you to estimate the division's beta, its cost of debt, and its capital structure. So there are different methods for doing this. First is the pure play method. You can find several publicly traded companies that operate exclusively within that division. You can use the average of their betas as a proxy for the project's beta, but it's often difficult to find companies that exist like this. Another is the accounting beta method, where you can run a regression between your project's ROA and the S&P index ROA. Accounting betas are usually correlated with market betas, but you can't normally get data on a new project's return on assets before the capital budgeting decision has already been made. So let's calculate the division's required return on equity. So if we know that they have a target debt ratio of 10%, their cost of debt is 12%, the risk-free rate is 5.6, they have a tax rate of 40%, the divisional beta is 1.7, and the market risk premium is 6%. We first need to calculate our required return. Our required return, we could use the capital asset pricing model because we have beta, the risk-free rates, and the market risk premium. So that says the risk-free rate plus the market risk premium times beta. The risk-free rate is 5.6%. Add to that the market risk premium of 6% times beta of 1.7. So that gives us a required return of 15.8% on equity. So this company, we're also assuming there is no preferred stock. So the weighted average cost of capital, we need to find the weight in debt times the cost of debt times 1 minus the tax rate plus the weight in common stock times the cost of common stock. Now we don't have to include preferred stock because the weight on preferred stock is going to be 0. So let's go ahead and plug in what we know. We know the weight in debt is 10% because they have a target debt ratio of 10%, times the cost of debt, which is 12%, times 1 minus the tax rate of 40%. Add to that the weight in common stock. The weight in common stock would have to be 1 minus the 10%, so 90%, because again your weights do have to sum to 100. So 90% times the cost of common stock equity, which is 15.8% that we just calculated, to give us a weighted average cost of capital of 14.94%. So the divisional weighted average cost of capital here is 14.94%. The company weighted average cost of capital is 10.4%. So in this division, it's riskier than the company as a whole. So when evaluating projects in this division, you should only accept them if their returns are greater than 14.9%. There are three different types of project risk. There's the standalone risk, the corporate risk, and the market risk. Standalone risk is the variability of a project's expected returns. A project with a high degree of standalone or corporate risk will not necessarily increase beta. It depends upon the correlation with other projects. Corporate risk is the variability the project contributes to the corporation's returns. And market risk is the risk of the project as seen by a well-diversified stockholder. Standalone risk is going to be the easiest to calculate. Market risk is theoretically best in most conditions, but it's the most difficult to calculate. But the creditors, customers, suppliers, and employees are most affected by corporate risk, so corporate risk is also important. There are some notes about flotation costs. Flotation costs depend on the risk of the firm and the type of capital being raised. Flotation costs are highest for common stock equity, but because companies issue equity infrequently, the per project cost is very small. So we often ignore flotation costs when calculating the weighted average cost of capital. With preferred stock, they may be a bit more substantial. Some other notes, when you're estimating the cost of debt, don't use the coupon rate on existing debt because that represents the cost of past debt. Use the current interest rate on new debt instead. When estimating the market risk premium for the CAPM approach, don't subtract the current long-term Treasury bond rate from the historical average return on common stocks. So for example, if the historical market return has been about 12.2% and inflation drives the current risk-free rate up to 10%, the current market premium is not 2.2% because again, this is historical and this is current, and we have to keep that in mind. We can't be switching it around. When estimating weights, we use the target capital structure to determine weights. If you don't know target weights, then use the current market value of equity. If you don't know the market value of debt, then use the book value of debt, especially when the debt is short term. Capital components are source of funding that come from investors. So as a reminder, accounts payable, accruals, and deferred taxes are not sources of funding that come from investors, so they're not included in the weighted average cost of capital. They are adjusted when we're looking at cash flows, but not when we're calculating weighted average cost of capital.